go ahead and I will call the meeting to order this morning. I believe in regards to our committee members, Mr. Austin will not be here today, and neither will Ms. McDonald today. So we'll begin with the approval of the August 23rd meeting minutes.
I move to approve the August 23rd, 2024 meeting minutes.
Okay. Second? Missy second. All in favor? Aye. Excellent. I do want to make you aware that there is a note to the agenda regarding the vote that we took for the Western Assets Core Plus funds. We had left the meeting on the 23rd with the understanding that after it had been reviewed, we would reach out to everyone to get an online vote. I really appreciate everyone taking the time to respond promptly to that, so we were able to move forward very quickly. Alrighty, so let's move on to the analysis of the investment performance for the period ending September 30th. Connie and Christian.
Thank you, Heather. Good morning, everybody. So we will start with that book, the analysis of investment performance, period ending September 30th, 2024. So we can also give you a verbal update on where we are more currently, but this is the most recent quarterly report through the end of September. So I'll start with a brief market overview. Overall, very strong quarter for the markets, both equity and fixed income. If you look at page 4, just looking at some of the equity index returns. So we are in the Russell 3000 index fund, which is the line on the bottom of that chart there, and you can see strong quarter up 6.2%, longer term 1-year number up 35%. IT stocks really continue to lead the way. If you look down at the sector returns on the bottom right hand of the page, you can see information technology for the 1-year period up 53%. So really a lot of those largest names in the stock index continuing to lead the overall market performance. If you look at the next page 5, international equity also has a strong quarter. The EFI index up 7.25%. Similarly, on the next page, emerging markets equity up 8.7 for the quarter. So really strong quarter globally, internationally, and longer term numbers across international, developed, and emerging markets also in strong double digits. If you look at moving to fixed income on page 7. You can see the U.S. Treasury yield curve as of the end of June. That's the yellow line at the top of the yield curve chart. You can see where we were as of the end of June, and then the green line is where we were as of the end of September. So across the fixed income yield curve, meaning whether you were borrowing cash for a month or 3 months or longer term 10 years, those yields came down during the quarter. Of course, the Federal Reserve made their first rate cut during the quarter for 50 basis points, and they did make a subsequent cut last week at their November meeting of another 25 basis points. So short-term rates came down, longer-term rates came down during the quarter, and as yields moved down, bond returns moved in positive directions. There was positive returns in the bond market, which you can see on page 8. The U.S. aggregate index up for the quarter of 5.2%. 1-year number there, 11.5%. Overall strong market performance. 12 gives kind of a written summary of a lot of the points that I'll highlight as we move through the report. So page 13 shows our asset allocation policy, and you can see we were just right about target, 48% in equity versus our target of 47% U.S. equity. International equity right at that 13% number, and fixed income at 39%. We did complete the rebalancing during the quarter, so we're now at our new targets. We did have a fixed income target of 30% and a total equity target of 70%, and now we're at 40% in fixed income and 60% in total equity, so bringing that risk down. Page 14 shows kind of the growth of the plan. For the quarter, growth of $10.5 million got us to the ending point of $202.2 million. Quarterly return of 5.8%. If you look at it on the one-year basis, you can see growth of $42 million, so and a return of nearly 27% on the one-year basis. So very strong asset growth. Cash flow has been neutral, and the growth has really come from the investment earnings. The performance of the plan and all of our managers are on page 15. So overall for the quarter, up 5.8% versus 6.2%, slightly trailing our policy benchmark. The majority of our assets, so if you look at the domestic equity is 48% in an index fund. In fixed income, we have about 16% in an index fund. So with over 60% of the assets invested passively or meant to track their benchmarks, any deviations from our other managers will have a more significant impact on that total fund performance versus the policy benchmark. So the real driver for that differential this quarter was the performance of the American Funds Euro Pacific Growth Fund, the international equity manager, who trailed their benchmark by about 2.5%. So overall, the U.S. equity portion, as I said, up 6.2% in line with the benchmark, one-year number up 35%. American Funds Euro Pacific trailed for the quarter. If you look at the 1 year, we've gotten behind by about 70 basis points. Since inception, which is all the way on the right, we have about 2.5 years with them, trailing by about 1%. If you look at the next page, page 16, we often like to look at kind of trailing historical calendar years. At this point, we only have one full calendar year, which was 2023, but they did outperform in 2023. 16.1 versus 15.6. So the underperformance this year is really driven by some of their holdings. A little underweight, Japan, which has done quite well, and some of their holdings in healthcare. They were very heavy into some of the manufacturers of weight loss drugs, and there's been more kind of competition in that space now, and so that hurt their performance a bit. But overall, no concerns. They're a well-diversified portfolio, and they're not, even though growth is in their name, they're not heavily overweight IT, which is the kind of the most growth sector. So we're not concerned really with their positions versus. Within fixed income, Dodge & Cox is our primary manager there, our core manager, very high quality. They can go up to about 5% or 20%, below investment grade, or what we call high yield, but they typically do not. They keep that under 5%. And so their quality is primarily AA bonds, which is the highest, second highest from the top that you can get. And so their performance has been quite strong over time. The quarter up 5.6 versus 5.2. Longer term, 1 year number outperforming by 2%. Similar differentials if you look out over the 3, 5, and since inception period. So we'll talk more about the fixed income portfolio overall. They're kind of the largest portion of that portfolio. We did add the index fund earlier this year. So this is our first full quarter of performance. At 16.3% target or current weight is a bit higher than we'd like it to be. So we're going to talk about introducing another Core Plus manager since we terminated Western Asset during the quarter.
And that is where the proceeds from Western went into that index fund.
Gotcha.
The next couple of pages are historical trailing calendar years and then historical trailing fiscal years. Page 17, you can see the fiscal year in June, 15%. Previous fiscal year, 13%. Other than 2022, which was kind of an anomaly year in the market, really strong historical fiscal years across the top of that page for the total fund. And then jumping ahead a couple of pages, we can actually kind of look at the cash flows that happened during the quarter. I will jump into page 28. This shows the movements that we've referenced so far. So we took $8 million from the Fidelity U.S. Equity Fund and $2 million from American Funds Euro Pacific Growth. That was the second half of the rebalancing back into fixed income. And then, as Kristen just said, we took the full proceeds from Western Asset and also moved that to the Fidelity U.S. Bond Index Fund. So kind of two parts of the rebalancing from equity to fixed, and then the termination of Western and temporarily into the index fund. The page before that, 27, just shows the growth over the last few years, and you can really see the significant growth even from the end of 2020 at just under $150 million. You know, the planet has grown over $50 million since then, so at $202 million today. Markets in October were looking great until the last day of the month, and then the stock market ended negative for the month, as well as fixed income. So far, month to date for November, stocks have been up almost 5%, and bonds have been negative. So the pie chart, which is a single page handout that we have, shows the assets as of Wednesday night, 203 million. So slight growth from where we were as of the end of the quarter.
Are there any questions regarding?
Tanya, at the risk of looking in the rearview mirror, how is WAMCO done since we exited?
So they've continued to bleed assets. They were in that Core Plus fund, I think they were about 19 billion coming into the incident, I'll call it, with the chief investment officer. They're down about half that now. They're about 10 billion in assets. They had a nice rally going into the fourth quarter, in part because in anticipation of the Fed cutting rates, we know bond yields came down. The way that they are strategically positioned almost always is to have an overweight to duration, so interest rate risk. So they really benefited from that, and actually you got a fair amount of that benefit. They continue to rally a bit after. Now they've given up a fair amount of those gains just because, especially post-election, we've seen another spike in bond yields. So all in all, you really haven't lost any ground at all. And actually, as you saw in the report, the timing of funding the index fund was quite good. And that's part of what we'll talk about with this manager search is just, you know, how complicated it is to sort of navigate this bond market world now, especially with the Fed cutting and potentially much more pro-growth, pro-inflation policies coming out of the new administration. So I think, in hindsight, wasn't a bad decision.
Thank you.
Excellent. So that moves us, I guess, to our next item, which was the Western Asset Core. So I think we provided an update in regard. Was there anything else you wanted to for that item? Excellent
We
segue.
have
Well done.
comments of thank you to the
Covered it. Got it.
Good check. So we're going to move on to the Core Plus fixed income search.
Yeah, and this is a bit of a doozy in terms of the amount of information in this report. So what I'm going to try to do as we move through is just highlight for you some of the key differences. We have, especially towards the back of the book, a great deal of information on each of these three firms that we're putting in front of you today for your consideration. And it's really driven by our research team and the work that they do. And there's a bit more on that on pages 4 and 5, just in terms of our research process and the different facets of an investment strategy that they consider when making a recommendation. So I'm not going to spend a lot of time on that, but if there's any questions about our process, feel free to let me know. I am going to start on page 3 with just sort of the parameters, the background of what we're trying to do here. And so the mandate listed there, we have 12.5 million, so that is the approximate amount that you liquidated from Western. So the idea here would be to start with a new allocation at that amount. And as I just said, given how things are changing in the world, it's conceivable that down the road we would maybe cut down an allocation to the index fund, maybe completely want to eliminate the index fund. But for now, getting another manager in this environment in place makes a lot of sense. Having that manager diversification and the ability to just sort of be a bit more, for lack of a better word, tactical as we move forward. So that 12.5 million, just to put that in perspective, it's about 6% of the total plan's assets. And it's about 15% of the fixed income basket, which, as Tanya showed you, at 40% of the portfolio, part of the reason we think having another fund in place is because that's a meaningful amount, 40% of the total assets. You see the list of the candidates there, and I think the important thing to know is these are all recommended managers that our team likes and has that rating on. So, you know, you probably heard this before, a consultant come in and say, we like all of them, you know, you can do well with any of them. We think there are some fit considerations here, so that's kind of what I want to try to emphasize as we move through this. But all good, reputable, well-known managers. Page 6 is just a little summary on who they are as a firm. And I think the biggest takeaway on this page is that PGIM, which is Prudential's fixed income arm, and PIMCO, which some of you may have heard of, are two giants in the fixed income industry. And you can see that in that total firm assets line, just comparing that to Reams, which we would refer to more as a boutique manager. So I think, you know, just to highlight, our team looks at everything, and there are instances where a Reams could be a good fit, and part of the reason we've included it here. But there is a meaningful difference in terms of the size of the firm, the amount of resources they have in-house, et cetera. So PGIM and PIMCO, both parts of publicly traded, very large entities. Reams, again, it is a part of Raymond James, which is a better-known U.S. financial institution, but the actual arm here, which operates pretty autonomously, is pretty small. I mean, $30 billion is nothing to sniff at, but compared to PGIM and PIMCO, much smaller teams. So the next few pages, 7, 8, and 9, are kind of a one-page summary for each of these firms. So the first one is PGIM. Again, this is Prudential's fixed income arm. The things I would highlight here is they do have a very large team, portfolio managers and analysts. That's highlighted in that first bullet. About 250 investment professionals, roughly split between portfolio managers and analysts. They do take a team-based approach. So there's been this evolution in the fixed income space where sort of the star model, and Bill Gross at PIMCO was the best example of this. Organizations have kind of moved away from that, because if a Bill Gross, who was a bit of an egomaniac, if he decides he wants to up and leave the firm, the business is in real trouble. So in sort of the post-Bill Gross world, these teams have been built out to be much more of a team approach. We think that's a good thing. PGIM is a good example of that. They've had some senior level portfolio manager turnover, and yet there's still a very deep bench there, and we're still very confident in the team that's still in place. The hallmarks of the portfolio, I'd say generally diversified portfolios. You're going to see that in the sector allocation. And then they take risk budgeting pretty seriously. So they're very thoughtful about having that diversified portfolio and thinking about how much risk is concentrated in each part of the portfolio. So we think that's an attractive element of their strategy. On page 8, so PIMCO, I'd say more similarities to PGIM than differences, especially when you factor in Reams. But if you think about PGIM as being large, PIMCO is even larger. You saw that in the assets, $2 trillion in assets that they manage. I mentioned Bill Gross. They've really grown out of his shadow. He left the firm in 2014. So they are taking more of a team-based approach now. If I were to contrast PIMCO to PGIM, I'd say PIMCO a bit more thematic in the way they think about the world, a bit more of a top-down influence. They still have a ton of credit research analysts. They're doing the bottom-up work, looking at balance sheets and financial statements and all that. But really, a lot of the decision-making is driven by their view of the world and what they think is going to happen. So a little bit of a contrast to PGIM, which again is going to be typically more balanced across different fixed income sectors. And then before I pause, just to contrast those two to Reams, again, I mentioned the word boutique. I think that's probably the best way to describe them. They're based in Indianapolis, not exactly a hotbed for investment management or fixed income managers. And they have a relatively small team. We talked about several hundred for PGIM and PIMCO. There's about 15 investment professionals on this team. So why do we include Reams? I think, you know, we have a few analysts in particular who just like the team, some of the people there, and the strategy. It is, I'd say, the most high conviction and most opportunistic of the group. So they do not fear making large, we'll call them bets, on things that they think are going to happen. A good example is the direction of interest rates, which a lot of us, including myself, think is a very difficult thing to try to time. They're not necessarily shy to try to do that. And actually, in some periods, it's worked very well for them. So we included that, you know, as a bit of a differentiator, but also if you think about the exposure that you had with Western, a a fund that could greatly outperform or underperform, and if you have other pieces in place, it could be sort of a good satellite. Now, I'll be upfront, we're not going to steer you in that direction, but we wanted to give you that contrast and sort of talk through it. Any questions just generally on the three?
So I just have a kind of a quick question. So when you guys were coming down to these three or whatever, like how many were you like looking at originally? Like you kind of, I don't know, like with my thought process on anything is like, you know, I come down to 10 and then I really narrow it down or whatever. Like what was your all's?
It's a great question. There are hundreds, probably about 100 institutionally known core plus fixed income managers. In our team knows them all, but I'd say that the ones that were under consideration, there were probably about 15.
Okay.
And then we sort of looked at the existing portfolio, looked at what the dynamics today, and this is actually a bit of a tricky conversation because when you look at the results, they don't look great for any of these three, but there's a forward-looking element to this. And part of it is explained by 2022, and we know how tough a year that was, and also how sort of unique the last, call it 4 years post-COVID have been. Not only COVID itself, but the inflationary environment with interest rates going up as much as they did. I mean, you'll see the 2022 results. I mean, there was nobody was spared, including the index. But in the years since, there's been a nice recovery, especially in the last, call it year and a half, 2 years, particularly for PGIM. And we think this environment is more typical of what we're going to see going forward. So we're trying to sort of mix the historical with, what is going to be the more likely environment here moving forward now that inflation, it's not dead, but it's not as big a risk as it's been. So to answer your question, 12 to 15 is typically the smaller universe of recommended core plus managers we look at. But based on feel, the existing portfolio, what's going on today, it's pretty easy to sort of narrow that down pretty quickly. Any other questions before I move forward, just in terms of the background and who these firms are? So page 10, we start looking at the characteristics of the portfolio, which I think is going to be a large driver, because again, these are all good firms. We're comfortable with the people in place. I think this gives you some sense of, again, some of the differences here. Starting at the top, the number of bonds, I wouldn't read too much into that. You can have thousands of bonds and not necessarily be more diversified. It just depends on where those exposures are, what sectors they're in. These firms, especially PGIM and PIMCO, they also utilize derivatives, which would be included in that number of bonds, even though it's not technically a bond. And a lot of people will hear the word derivatives and it has sort of a negative connotation, but by and large, these are things like interest rate futures, currency forwards, things that are being used to sort of manage the exposure in the portfolio as opposed to trying to take a ton of risk and get a ton of return. So it's certainly the norm in the world today in terms of how these firms operate, so I wouldn't, again, read too much into that. Yield to maturity, so that's a pretty good indication of what we think the return opportunity is over the long term. And if you contrast that to the last column, which is the Bloomberg index, they all have what we'd say is a yield advantage. And that's what you want, because you're paying them more money than you do for the index fund. You want them to outperform over time. They take a little bit more risk typically to do that. But where that shows up in terms of the benefit is that yield to maturity. So put differently, if you look at PGIM with a 5.6% yield to maturity, reasonable expectation that the next 5-7 years, something in the area of about a 5% annualized return. And then effective duration, that's sort of the second key portfolio stat that everybody looks at just to think about return and risk, yield being the return potential, duration. Think of that as the level of sensitivity to interest rates. The higher the number, the more sensitivity, but one way to think about this simply is that if interest rates or bond yields fall by 1%, you would expect the portfolio to appreciate by about 6%. And it works conversely too. There are other things, dynamics that throw off the exact math, but that's the concept there. So when you think about interest rate exposure and the risk there, the higher the number, the more risk. What I'd say here is these are all pretty much right now close to the index. The one that's going to be more out there typically is Reams. So again, more like Western and what you had before in terms of being a bit riskier on that front, but these are all levels very consistent with what you see in the benchmark today. Any questions here? Okay. Page 11. So on the left side of the page, these are all the different sectors of the fixed income market. And then the percentages you see underneath each, including the index to the far right, that is the exposure that they have in the portfolio today. And I emphasize today because these are active strategies and these will change, but I'd say they change to differing degrees. Again, PGIM, you see the most sort of smattering across the board, and that is consistent with their approach. They're going to be the most diversified by sector. Those percentages will change, but they're typically going to have exposure to all of these things. In the case of PIMCO and Reams, it's less, there's sort of less conviction. Reams, you see 0 in high yield, municipal, that's developed. If there are any questions about what these are, let me know. I'll highlight a few. MBS, that's mortgage-backed securities. ABS is asset-backed securities. In anticipation of one question there, PGIM has 22% in asset-backed securities. Typically, that's going to be a mix of things like credit card receivables, auto loans, student loans. There are a few other more idiosyncratic type of exposures, but that's a relatively large exposure they have there compared to the others. The other thing I'd highlight on PGIM is that their treasury, which you're going to have a lot of in the index, and you see that at the far right, 40% in the index. PGIM has about 8. Keep your eyes on that treasury line. Reams, higher exposure to the treasury line today. Again, I mentioned the fact that they're not afraid to make interest rate bets. And so not uncommon to see Reams pretty heavily allocated to treasuries, but also investment grade corporate bonds. Now, one thing to keep in mind when we move to performance, that high yield corporate line, I'd say all 3 of these are modest, and that plays a role in why they've had lower returns than some of their peers in recent years, because we know that, you know, in this environment, a lot of people have been surprised how well corporations have continued to do, and part of that is reflected in the returns of high yield, which is lower quality bonds. The impact, though, of having that high yield exposure has been pretty dramatic. I mean, it's grossly outperformed every other sector. And so there are some peers, again, in this universe who have 20, 25% in high yield, and they've just shot the lights out compared to these 3. So again, sort of teeing up what you're going to see in the performance, that's, again, part of the reason why these strategies have not performed as well. We don't necessarily think they should be punished based on that. We think the higher quality bias in this environment is not a bad idea. The other things to highlight here, PIMCO, 42% in mortgage-backed securities. Again, that's reflective of their thematic view. They do have less in treasuries, but mortgage-backed securities, particularly government-sponsored mortgage-backed securities, are still very high quality. And part of the reason PIMCO in particular has underperformed is because they've been quite cautious with risk. The last thing just to say is, when you think about the environment going forward, for investment grade corporate bonds and high yield, the spread or the additional return that you expect to get for investing in those 2 sectors instead of treasury bonds is as tight as it has been in the last 25 years. So put differently, there's a fair amount of risk today, we think, in allocating too heavily to the corporate sector. And so that's part of the reason PIMCO in particular, in their thematic approach, they have a pretty modest allocation here to investment grade bonds. PGIM too, that's part of the reason why they favored some of the other sectors. But again, Reams differentiated because they're going to stay pretty heavily in that investment grade bucket no matter what. That's a lot of information. I know probably not totally clear, but hopefully gives you, again, a bit of a sense of the differences and how they go about things. Any questions here? We have the fees on page 12. So for context, Western's fee was 45 basis points, or 0.45%. The index fund you have now is 0.025%, or 2.5 basis points. Again, you're not paying for active management, so it's much cheaper. So you can see that these, and actually your other fixed income manager, Dodge & Cox, 0.41, or 41 basis points. So these are all kind of, I'd say, at or in between Dodge & Cox and Western. PGIM is the most favorable at 39. And so, you know, I wouldn't necessarily make a decision based on these differentials because they're not that material in the scheme of things, but all are pretty consistently priced with other institutional mutual funds that we see in the universe. Okay, why don't we jump to 14? I promise I won't do too many more slides, but this I think, if you can read it, you go sort of down. So the focus on the lines with the shapes next to them that are colored. You'll see PGIM is the blue triangle, PIMCO is the red bigon or circle, and Reams is the starish looking, also blue line. So you'll see a number under each time period, that's the return. So for instance, if you look at PGIM and you look at the YTD column, that 5.85%, that's their return year to date. That number under the RK column is the rank, that says 31. So a lower number is better in terms of the ranking. And what are we comparing to? We're comparing to a universe of other strategies that are similar in style, sort of fit this core plus universe that we've been talking about. So again, as you look further to the right, you'll see in the 3 to 5 year period and 7 years, depending on which fund, the rankings don't look great, especially for PIMCO. The PGIM, if you look at the 5 years, 0.82% return, ranks in the 90th percentile of the universe. What I would point out in all of these periods is that they are outperforming the index, which is the Bloomberg index, which is the last black box. And again, I want to reemphasize the point that I made earlier that a lot of their peers in this universe have been more heavily allocated to things like high yield bonds that are of lower quality. What I would say more recently is PGIM, you've seen a turnaround in performance. So if you look at their 1 year number, 13.4% return, that ranks 31st. So the last 2 years have been better. PIMCO, similarly, a 13% return, ranks right about at the median, 49th percentile. And then Reams, which actually, as I mentioned earlier, had done very well based on some interest rate bets coming out of the COVID period and through making good calls in the inflationary period we were in, they've sort of tailed off a bit and performance has been a bit more modest. Also important to keep in mind that when we talk about fixed income, the range of outcomes is much narrower than it is when we talk about equity managers. So, for instance, in most of these periods, the difference we're talking about versus the benchmark or even versus other peers, it's 0.5%, maybe 1%, maybe in extreme periods 1 or 2%. The bottom line is fixed income is a much different asset class than you see in things like equity and some of the alternative asset classes. So again, these rankings I think should be taken in the context of what's going on with their style and the world we've been in and what could be different going forward. Any questions here? Okay. Page 15 shows the returns, but instead of trailing periods, we're showing it by calendar year. I did just make a couple points here. Again, Reams, if you look at their 2020 return, 16.56%, which ranked just near the very top of the universe. It was roughly double most other peers, including PGIM and PIMCO, and double the index. If you removed the impact of a year like that, Reams looks a lot less extraordinary, and I highlight that not necessarily to knock them, but again, it gives you a sense of their style and how aggressive they're willing to be, and again, may not be the best fit in this context, especially given what we've been through recently with Western, which had some performance struggles even before the personnel issue that we had. If we jump, I'm going to do 2 more pages and then stop. We can open it up. Standard deviation is a basic measure of risk on page 16. And we're showing this on a rolling basis, which means for every time period that you see at the bottom of the page, the bottom half, at the top of the line, you'll see a time range period. It's a 5-year period, excuse me, a 3-year period, and we're just sort of rolling the last 3 years forward. And the actual numbers that you see under each of those columns is the standard deviation. It's a basic measure of risk. The lower, typically, the better. And so what I'd say, Reams, not surprisingly, overall, the highest volatility. PGIM, given the fact that they were kind of on the wrong side of those interest rate movements during that inflationary period up until about the end of 2022, their standard deviation looks a bit higher. But I think if you look at the most recent rolling period, which is the bottom section, so April 21 through March 24, July 21 through June 24, and October 2021 through September 2024. If you look there, I think that's pretty indicative of what to expect going forward. You've got PGIM and PIMCO with risk or volatility that's a little bit above the benchmark. Reams a bit more meaningfully so above the benchmark. But again, with the environment today and inflation being less of a risk, though not dead, I think sort of a 7 to 8% level of volatility, which is consistent with the aggregate index, is what to expect going forward. So the last one I'll hit is page 18. This is the information ratio is a measure that we look at to assess the manager's ability relative to the benchmark to get returns in the context of risk. So that's convoluted. Let me try to explain that better. Think about active return. So return relative to the benchmark being the numerator, and the denominator is the volatility of the fund relative to the benchmark. So return on the top, risk on the bottom, but all relative to the benchmark. So again, the higher the number, the better. And this has varied a bit over time as well. But again, I think if you look at those bottom three, the most recent periods, the rolling experience, you've got Reams a bit above PGIM and PIMCO, sort of third, ranking third. PIMCO here in all these results is being punished not because they've had a big downturn, but more because they just haven't taken a lot of risk in the portfolio. It's kind of hard to think about how that could happen, but if especially high yield returns are very strong and they're simply not allocated to that sector, no matter what you look at on a backward looking basis, it's just not going to look as strong, and that's what you're seeing here with PIMCO. Going forward, what to expect in terms of the ability to outperform the index. We think long term, just given the yield advantage that I showed you before for all three of these, over time these should out-return the index, and they're not doing it with a ton more risk than the index. So again, going back to the point of diversification and having another manager in place, we think that makes a lot of sense. And you could probably tell by now, what we think in terms of what the best fit would be, but before we sort of talk about that more directly, are there any questions just about? Yeah.
I have a question on page 17. What is that chart actually telling me?
So tracking error is, we talked about standard deviation. Think of standard deviation as just the absolute level of risk. Mm-hmm. Tracking error is like standard deviation, but it's the risk relative to the benchmark. So it's volatility relative to the benchmark as opposed to standalone volatility. So the lines, what it means by 3-year rolling, which it says at the top, is for every time period, it's pulling with it the last 3 years. Because one of the problems when we look at all these numbers is there's an endpoint bias. If it happens to be a good ending period, then they're going to look good. If it's a bad ending period. So by pulling the last 3 years with it, it smooths that out a little bit. You want a lower tracking error, I mean, in most cases, unless you're not afraid to take risk relative to the benchmark. And part of that, again, goes back to the conversation about what's already in place. And you want to have conversations where your manager is, seriously underperforming the benchmark. If you don't, then you should try to minimize tracking error. That was kind of, our feel coming in when we were having the Western discussions. Western was already on the watch list. There was nothing organizationally wrong with Western, but the way that they construct their portfolio and the way they operate, it is a high tracking error strategy. And so if you want to have to spend time in those conversations, if you're more concentrating on just beating the benchmark by 0.5% every year, then you don't really need to worry about tracking error. And that's why you see Reams really spike up relative to the others. That's PGIM spiking up in the recent period. Over time, we'd expect Reams to be the highest.
It goes back up to the highest and more.
Right, exactly.
If I'm reading that
Yeah,
correctly.
that's right.
All right, thank you.
Hopefully that.
Yes.
Clear. Okay. So different ways to think about it. You want to look at the returns, and that's a consideration, but you also want to think about the risk. And then, again, it's been a very unusual environment for the bond world the last few years, and we don't, especially now that the yields are higher, there's more cushion baked into them. Like we don't expect that sort of volatility in bond land to exist going forward. Could be some up and downs. I mean, that's part of investing, but not like we've seen the last 3 years. Any other questions?
So when you said that, so given some of the what the perceived new moving forward will be with our government. You don't perceive that because of the cushion, because of that it's not gonna be volatile based upon because of, if tariffs,
Yeah.
you could be in a position where we see more deficits, higher deficits, lowering the taxes,
There-
inflation moving up. I mean, so does that, I know it's so early and nothing's happened, so how do you, I know you don't have a crystal ball, because if you did, you wouldn't be here. You'd be on the beach in Bora Bora, right? So, but I just wonder what that, is that a concern? And maybe we won't know for a year.
Yeah. It's kind of like, the Fed's been saying is they're focused on the policies in front of them and trying to forecast how that all plays out, what tariffs get implemented where and at what level, what the ultimate impact here, because there are a lot of proposed policies at this point that are somewhat offsetting in terms of, potential impact on the labor force, pro-growth, yet pro-inflation. Things like pro-growth policies are going to help these sectors that are outside of the treasuries. So the corporate sector, like I talked about how the additional compensation you get for investing in a corporate bond is as low as it's been in 25 years. Well, it could stay there for another 5 years if we get all these pro-growth policies. Then offsetting that, if you have all these pro-growth policies, you have a declining workforce, the risk of inflation coming back is certainly a threat. Who knows, right? Like, it's just really tough to forecast. The biggest difference, though, to us now versus 3 years ago is that the starting point on bonds, the starting point on interest rates was 0. The starting point on bonds was a 2% yield, and now we're still closer to a 5% yield. And estimated interest rates that are starting, at least at this point, to come down. So to the point I made earlier about more cushion baked in, there's just more of a buffer there to sort of offset negative things that could happen. Where does inflation go from here? I wish I could tell you, yeah. Like, we'll see, I guess. But, generally having a good starting point historically in terms of the yield on your bonds has been a good predictor of what the return is going to be the next 5, 7, 10 years. And a 4.5% to 5% starting point feels a lot better than a 2% starting point.
Absolutely.
So it's a reasonable question, and glad you asked, but
Time will tell,
Time
right?
will tell, yeah.
We'll be having these
And,
conversations.
going back to the point about diversification and having multiple managers and the index fund, you'll have some pieces here that we can sort of move around. We're not going to trade the portfolio in and out, but if it looks like the benefit of having an index fund, even though it's low cost, isn't going to be there at some point longer term because you have all this treasury exposure and they can't be as dynamic moving that around, then we can sort of start to move that down a bit and let the active managers who are in the weeds with this every day make more of that decision. That's sort of our thinking.
I appreciate that, thank you.
Any other questions?
So if you put these three up against Dodge and Cox, is there one that complements or the other way around that portfolio? And that's one question, and then maybe this is a part question, I'm not sure, but we have the index, so do we care as much about tracking error because we already have an allegation to it?
Yeah. Good questions. Page 26, we do show the correlation matrix. The higher the number, think of 0 as the bottom, 1 is the highest. The higher the number, the more strongly correlated the two are. So you want, typically, for a portfolio, you want diversification. Actually, the lowest is -1. So if you look at different asset classes like treasuries versus equities, you tend to see a negative correlation. Here, they're all positive, not surprising, because they're all essentially doing the same thing. They play in the same sandbox. But Reams has the lowest correlation to Dodge and Cox. Now, I personally would take this with a grain of salt because the magnitude of difference here is not large. If you factored in the index fund, it's going to depend on the period. So going back to that sector chart on page 11. What I would say today is you probably see PIMCO set up, even though the treasury exposure is lower than Reams for PIMCO, and we see that the index has 45% in treasury. The actual experience of PIMCO, I would expect right now is gonna be the most like the index, and that's because of that mortgage exposure at 40%, because as you know, Brian, agency mortgages, you're basically investing them from a point of sort of caution. You're getting a bit of spread above the treasuries, but they're a very safe, implicitly government-backed security. So it goes back to the point about PIMCO being the most cautious, Reams being arguably the most aggressive, and PGIM just being, you know, the most diversified and well-diversified in sectors that aren't in the index. So Tanya and I actually looked at one other thing which we didn't include because we didn't want to drown you in data, but it was if you factor in, and this was Tanya's idea, which is a great one, if you factor in each of these managers into the existing mix at the same level that Western was, like the same breakdown percentage of the portfolio, what is the difference and how does the performance look? Not surprisingly, right now with Reams, it looks the best. But again, the difference, because we're implementing this at only $12.5 million, 6% of the total fund, it doesn't have a huge impact over time. So it's kind of, I think the best way to think about Reams is Reams we would not recommend in a portfolio as a standalone investment. And so to your point, do you care as much about tracking error? You know, you want to take a little bit of risk here. That's probably the best candidate if you're not worried about tracking error. I sort of know the psychology typically of people in these meetings and when we meet, and it's you can't not focus on the short term even though it doesn't do a lot of good to do it. So that's sort of where we land on that. I think over time though, all three of these we would expect to add value relative to the index. Did I answer your question?
And then Reams being smaller, the AUM, if they were to have outflows for any reason, like how would you guys typically approach if we became a bigger portion of their fund? It's still, quote, only 12.5 million, so on a multi-billion-dollar fund, but how do you guys approach that?
You take that?
Yeah, I mean, that's always a risk, I think, with a smaller shop in particular, and more particular to the actual fund size, right? Reams has, a few different investments, but we would be a portion of one of their funds. But I think there's a threshold where we do monitor that, and if it gets to a point where we're seeing outflows or we feel like, one of our clients' investments with one manager is becoming too large of a portion in that fund, that is a concern, and that is something we would come to you with and have discussions about and potentially recommend a change. So that is something to be mindful of, I think, to your point. And that's a risk with a smaller shop.
Just for context, you saw the assets for Reams, 29 billion. If you look at this particular fund, there's 1.8 billion. So 12.5 million on 1.8 billion. I think a lot would have to go wrong for that to be a concern anytime soon. It happens Western, right? But it's, to Tanya's point, it's something that we keep a close eye on.
So you're gonna want a recommendation from
Well,
this discussion?
We can sort of lay out what our thinking was here. I think we've done most of it, but again, if there are, we can make this a conversation. We are comfortable with all three of these managers. We think there's an argument for fit here for one in particular, but it plays back to the story about what you have in place and how comfortable you are with tracking error. So, however you want to proceed.
So I have my ideas from what you presented, but I'd like to know what your have an ultimate recommendation.
Sure. We think, again, having manager diversification, having a lot of sector diversification, a lot of unknowns in the world today, an improved track record in recent years and what we think is going to be more likely the norm moving forward. Of the three, we think the best fit is PGIM. And it was not, we didn't reach that conclusion easily, and we went sort of back and forth a few times. But we see the merits of the other two, PIMCO, I'd say, being the most cautiously positioned now, the most, let's say, punished fairly or unfairly based on having a more conservative approach in recent years. And then Reams, you know, if the philosophy again is a bit more opportunistic and okay with the tracking error and being a bit riskier, then Reams could fit here as a nice satellite to what's otherwise in place. So I think, again, what we walked into with Western, you know, how that played out, sort of, not gray hairs, but, you know, the stress that a fund like that can cause when it's a bit more volatile. It's just something that we took into account when we made that judgment.
So for what it's worth, I came to the same conclusion. Mine was based on, if you look at the sector allocation, to me, PGIM has what I'll call more shots on goal. And I've seen PIMCO kind of knock it out of the park, and then the next quarter or year, they quote blow up. Not maybe they don't blow up. So I'm a little nervous about that. If you look at their performance relative to each other, PGIM consistently outperforms PIMCO. Reams is kind of, again, you hit it out of the park, and then you get it back after that or whatever. So, and I agree, like, there's places for all three, and then lastly, I'm a little biased because I know some of the analysts at PGIM, and they're very high quality and very thoughtful and overall somewhat cautious. So that's my thought.
We should have given our presentation. Much more succinct than it was.
We want all
That's
that
right.
information you're
You
giving
gave us all the information.
Yeah, absolutely.
There's more in the back, pages and pages.
You can read all of them tonight when you're going to sleep.
So I think at this point, I mean, to me, I think we need to decide, and I think we are in a position where I think it would be beneficial to move out, get a little bit more diversified, and move out of that fixed, where we are,
Right, all of it sitting in.
yeah, all of them sitting in that
unmanaged.
one, and consider that. So, is there any conversations about the other funds? I mean, my 2 cents is I was thinking the same thing. Because of the, I think the
Yeah.
diversification of the PGIM is really considering where we are at this point and where we don't know where we're going, you know, as transitions happen. I think for us that, and, you know, we're risk averse by our nature.
Well, especially since we haven't put any money in OPEB in 2 years, we have to very much protect what's in there and make sure it's growing, because we're not adding to it. And so,
I'm sitting right here.
I know. There is nothing I'm saying that I didn't stand up and publicly say in the meeting when you all made that decision. But it is a consideration. If you're not adding to it, you have to be more protective of what's there. And I agree, in the environment we have now, nobody has a crystal ball, but we don't know which sectors are going to be more adversely hit, because as the cabinet picks keep coming out, there's uncertainty with every single one of them where they're going to take everything. If you look at, like, who's going to run the EPA, that affects corporations in a certain way. Who's going to run, but we don't know where a lot of these are going, which just means more diversification. To me, more diversification, the better, because we don't know where's going to be the bump and have a good reaction, where's going to be the hit to take.
I have a question. Based on like our budget issues that we're facing and everything, what is the plan of is it still like a 10-year timeline of when we think we might need to start using OPEB, or is that?
We haven't, that is
don't?
something, yeah, we're not at a
Okay.
point now where we,
No.
I don't see that, I don't foresee that in the next 10 years.
Okay.
And I think, given where we are, and, I think our ACFR, we were at 28% funded at the end of 6/30 this year. You would know that number probably better than I do. But that, I said, there's caution, because of course that is a calculation that's done by our actuary every year, and they've cautioned us that their discount rate may change based upon our not putting into the fund, so that number can change. And we also know that you know, that is about all of our retirees, and we're all not, people who work here are not all retiring tomorrow together. So
Right,
7,500 of us.
and we're not paying for their health care for the next 50 years in one lump sum because
Right.
CareFirst wouldn't take the money from
Right,
us.
absolutely. So we know that, you know, those calculations all have assumptions built into them. But they are good benchmarks because they give us, you know, every year, it gives us, we're looking at the same calculation every year and how the percentage changes. But at this point, no, we are not considering. That retiree costs, I think, I have to get the numbers off the top of my head, $16 to $17 million is what the board's cost of that is, I believe. It might be closer to 19. I'll have to go back and double check, but it's not, of that, the health insurance budget itself is over $100 million. So as a proportion of the health insurance budget, it's probably heading towards 20%. So there's, you know, but there's a number of factors that go into those decisions being made. And it's also, I think it's one of those ideas that once you open that door, it's hard to shut that door again. So, you know, and given where we are. But, you know, I think from an operating standpoint of our budget, based upon the spending affordability committee meeting that happened this week at the state, I think there's years where we are in a position where we're going to be not in a great position for probably the next 5 years is what that spending affordability is showing. So being cautious in the work that we're doing in this fund, I think is appropriate, given those factors. And, you know, again, none of us have a crystal ball, so what happens as we move forward? We're making a decision today. Fortunately, we meet quarterly, and just like with the Western assets, when things went in a way that did not feel good for us, we were able to react to it very quickly in regards to that. So I think at this point, I think it's probably appropriate for us to have a vote on the, if we have a consensus that PGIM is the way that we want to go. So we'll have a vote on that if anybody would like to make the motion.
So to be clear, because I think the motion should include where the funds are coming from and.
Correct, absolutely.
Can you kind of outline
So the funds would be coming,
From the Fidelity Bond Index.
okay, yes.
12 and a half.
The Fidelity US Bond Index is where it would be coming from.
Correct.
So it'd be $12.5 million from the Fidelity US Bond Index to the PGIM fixed income. You're used to writing, you know, getting these motions down, aren't you? So that would be the consideration of the recommendation. Now, if, like we did the last time where we did it in two sums, I don't know if that's something we would want to consider that as well at this time.
Is there a reason to break it down?
Really, that was,
That's as important in this
yeah,
particular
exactly.
investment, is it?
That was selling out of the equity market and it was a larger sum, so we were more uncertain of the timing there, but I think this one makes more sense to do in one shot.
And not to split hairs, but do we need to approve them as an investment, or can we just say we want to allocate it from here to here? Like, is it a two-step process, or can it be done in one?
I think it can be done in one.
Contained within one motion.
Absolutely.
Yeah.
Then I'll make a motion to transfer $12.5 million from the Fidelity US Bond Index into the Prudential Core Plus Fund.
Second.
All those in favor? Okay, the motion carries.
Brian, sorry, through yesterday's close, Western is flat for the year-to-date period, and the index is up 1.8%, so still lagging. Made up a bit of ground, but still lagging.
So are there any other questions for today? Our next meeting is virtual and will be in the new calendar year, so we'll see you in February. February 21st. God, gosh, that's hard to believe. 2025, my gracious. So thank you all for your time. What?
I said that, we're in Buck Rogers years.
Oh, yes, I know.
That's dating me.
We'll know a lot about February 21st.
Yes, yeah, we should have some more idea of the impact of the election by February 21st.
Absolutely,
And our budget.
absolutely.
And yes, and budget.
For your information, the
Sort of.
state releases their budget on the third Wednesday of January. Of course, we don't hear from the county council until, county executive, until tax day. It's a fitting day to release a budget. So that
The
will
state
have.
already sent us a nice hint.
Yeah. Yeah.
Yeah.
Thank you all for your time.
Thank you. Thank you all very much. Thank you.